Happy Friday, everybody. Welcome into the Mining Stock Daily long form episode this week, and it is a good one. It's a real pleasure to welcome in Jonathan Goodman from Dundee Partners and former chairman, Dundee Precious Metals, and we talk a lot of things, just the kind of the nature of the gold mining sector as a financial instrument, what needs to be improved, what has been improved. John wrote a long form editorial about 5 or 6 years ago called The Elephant in the Room. And a lot of the conversation with Jonathan over the next hour is really kind of based on what he wrote. And so we kind of go back and forth. I'm going to leave a link to that article in the show notes for you to reference as well. And we talk a lot about exploration, private cos versus public cos, when to go public, and really how to notice good and bad technical reports. So there's a lot of great information in here from the legendary Jonathan Goodman. Special thank you to Visa Silver, Fireweed Metals, Arizona Sonoran Copper, and Victoria Gold for their continued support of the podcast. And as always, if you wouldn't mind, press like, subscribe, share, all those things on the podcast or on the YouTube channel. And we really appreciate your feedback. All right, everybody, let's get into this wonderful conversation with Jonathan Goodman. All right, welcome into Mining Stock Daily, everybody. This is going to be this week's long-form interview discussion, and it's a real privilege and honor to welcome in Jonathan Goodman. He is the president and CEO of Dundee Corporation. Always outspoken and always a great, fantastic ideas, a ton of insights and thoughts on what is happening in the gold mining space and also in the gold markets. And come to find out, after doing a little bit more due diligence in his background, he knows exactly where I live because he went to school in the area. So, John, thanks so much for doing this. Good morning. How are you?
Well, how are you, Trevor? Thank you for having me.
Yeah, thank you so much for joining us. I'm doing excellent. Let's. There's a number of things I want to take this discussion, the time that we have. But I thought I would kind of dive into Dundee Corporation a little bit. You've been the president and CEO, I think, about 6-7 years now. And I'm wondering if you could kind of go back and talk about the evolution of Dundee Corporation, not to be confused with Dundee Precious Metals, although there is a linkage there, and kind of talk about just how this business has evolved over the last 10 years.
Well, I'll go back more than 10 years. Dundee Corporation started 30 years ago, and it was started by my father, but it was a mix of really three businesses. The first business was the mining merchant banking business, which back then, I think we had a merchant bank that was run by Bob Bucket. And we also had an investment management business. We managed the dynamic mutual funds. And later on, we started a real estate business. Now, in, I think 2010, we sold the mutual fund business to Bank of Nova Scotia. And the real estate business we spun off. So when you look at our share price today, you have to recognize, Dream, which is the spin-off company we did, every Dundee Corp shareholder got half a share of Dream. So we basically spun off $10 a share, because Dream's trading at $20 a share. So, and what we're left with is, we were left when I came back with the remainder, but it wasn't really just a mining merchant bank. We had ventured outside of mining. And, the mining industry had been through some tough times, as well as some of the other ventures that we got into. And so when I came back, my real goal was, let's reestablish what we know. Let's stay in our lane. And what we know is we know mining. And we know mining really well. So the focus I've had over the last years is severalfold. One, I had to cut the G&A down because we've morphed from a much larger company to a smaller company. We had to work on our balance sheets. So we sold a bunch of assets. We've paid down some prefs. We've converted some preferred shares. We've sold some assets and paid down some debt, where our debt and preferreds as a percentage of book value now is now around 20%. So it's now in good working order, and our G&A is down quite dramatically. And we've also built ourselves what I would say is the premier mining investment business. And that's really what the focus behind the scenes is. And you talk about a lot of the stuff you've mentioned the elephant in the room before we got on, and what we've concluded is if we're going to be wrong in the mining business, we want the mistakes to be our mistakes, not mistakes because someone told us something that's not true. So what we do and what's unique about us is we sign a confidentiality agreement when we look at an asset. I've in building this mining team, I like to say I built it with purpose, but I've got a combination of people that I've worked with for 20 plus years through the Dundee Precious Metals days, and some younger people that we're working with and training up. And we sign those CAs and we do a very deep dive due diligence. We do, in many cases, we do our own resources, we do our own reserves, we do our own pit ops, we've done some stope ops as well, and we come to a conclusion of what we think this mine, when built, could produce, what it'll cost to produce, what it will produce, and we develop a plan. And then we try and work with managements to get into that plan. And I think that and then hopefully we commit some capital to making that plan come true with the management teams. So that's,
yeah, we can dive into kind of the due process and due diligence you and your colleagues perform before getting into a position. But I do want to go back and ask you about when Dundee Corp did diversify a little bit. What exactly, when was that diversification happening?
it was probably happening sometime between 2000 and probably 2000 and I don't know exactly when, because as you know, I went and ran Dundee Precious Metals, so I was kind of focused elsewhere. But I think it was somewhere between 2008 and 2014, 15.
Okay, so it's kind of going on with that big commodity super cycle, the height of it, and then kind of the fallout after the 2012. Okay. Well, the reason I asked is because I was just kind of reading a little bit in a book, The War Below, that was just published a couple of months ago, about just kind of the fallout when Freeport McMoran tried to diversify and go into oil and gas. And obviously that turned to be incredibly detrimental for them, and they lost mining projects trying to clean up those books after that decision made. I mean, was that kind of happening about the same time? And were there other companies out there doing this quote unquote diversifications, just not devoting it all, just 100% of their time to mining projects?
The mining sector was in, kind of a lull. And so there were other projects that came, and, I can't really comment because even though it's still my family, my father was doing it. I really wasn't. I was full-time focused on Dundee Precious Metals at the time, so I didn't really pay attention to what other companies are doing. And so it's not a lot of I know we got into some things that I think we all wish we didn't get into, but that's really as far as I can take.
Yeah, very good. Well, let's stick with the mining sector. This is all, I think a majority of this conversation, John, is going to go back into this elephant in the room, because that's just a big general theme of the discussion, the talking points I want to hit home with you. But there has, if you think about the gold equities themselves, we're pushing here 15 years of really underperformance compared to the gold price. There's this kind of expectation here of now with $2,300 gold. Is this going to be the tide that lifts all boats? And certainly has not been the case. I mean, and it's not, there's a number of pointing factors here that, people could kind of blame at. Some of it has to do with markets, the institutional financialization of these equities, but a lot of it is cost inflation as well. If you look at the last, 3 or 4 years coming out of, the beginning of COVID and this not so transitory inflationary push, what has been the biggest driver of underperformance here, if you just narrow it down the last 3 years?
Well, I think for me, I mean, you were looking at, I'm just looking at our version of that chart, which I could send you later. But since the GDXJ was first launched in November of 2009, the price of gold has gone up by 177%, and the GDXJ has gone down by negative 42%. And the part that's even more astonishing is right through that piece, mines made money. If you look back, I mean, they don't have all-in sustaining cost data going back that whole period of time, but there is cost data. And even when gold was $600 an ounce, the mines made money. And somewhere between, another article we wrote was mines make money, but mining investors don't. And I think that's something we have to come to terms with, is that as investors, we really need to have different set of expectations from the companies and the managements of the companies in which we invest, because it shouldn't be a scenario where CEOs are retiring very wealthy, whereas the investors didn't make any money. That's a misfit in what's happened. And I think from our perspective, because when I started in this business in the 1980s, everybody bought gold stocks because that was how you got exposure to gold. But if you and I said, how could you get exposure to gold today? There's a million ways to get exposure to gold. One of it is just to buy gold, which you couldn't really do that easily. You can do it a lot easier now. If you want a levered gold play, you can actually buy gold in a structured product with some debt embedded into it, so you get the leverage, which would make it more similar to a gold stock, or just borrow money and buy gold. So gold stocks have to give people a reason to own them that's not just gold. And I think that's where a lot of companies fall flat. I think we're now in an era where you actually have to devise your company where there's some type of financial reason. It's okay, you produce gold, there needs to be some growth or some dividend or some long life or something unique about that stock that's going to give you something better than just owning gold. And I think that, and I think a lot of CEOs are now doing that. I think you're starting to see it, and the ones that have done a good job have performed. So, but I think that to me, that's the big takeaway, is that nobody needs a gold stock. So if they don't need it, you have to give them a reason to want to own it.
Are there, you mentioned some CEOs are doing it right in your eyes? I mean, could I ask you to maybe single one or two out and give us an example?
You can easily single out Alamos Gold and Agnico. Both those two companies have done a great job for a long time. And their stocks have performed. I don't have the charts in front of me, so I'm sure.
I can tell you they've done well. I've got the Agnico chart in front of me somewhere on this computer screen. So let's talk about lessons learned. There was a lot of things were way overdone in 2011 at the end of the height of that cycle, right, John? So, and a lot of people are overly critical, maybe rightfully so, of gold mining companies and just the mismanagement of their capital and overspend and maybe even just cost overruns in so many areas, even prior to the inflationary pressures of the last couple of years. From you see, you talk to a lot of people and are highly respected. Are new management teams that are in these positions now, have they learned the lessons of the mishaps from their predecessors, and are those changes being made?
I'm not sure they have. As I said, I highlighted some good ones. I don't want to highlight bad ones, but I think that I don't think the industry is where it needs to be yet. I think that, and it's not just producing; it's right across the board. To some extent, I like to blame some of these 43-101 reports, because to some extent, we all get them and we all do valuations off of them, and these aren't supposed to be valuation reports. They're supposed to show feasibility. They're supposed to show you the path forward for the project. And so we create these very, very beautiful reports, and then the need for capital gets involved, and management's put a lot of pressure on the consultants to make these reports into something like a best case scenario, because they know that their shareholders are going to take them and do a valuation on them, rather than look at them and say, what are we learning about the ore bodies? What are we learning about the deposits here? And how can we use this report to make a better decision making? And as a result, that none of these assets ever perform as well as the reports say they could, because the reports are too optimistic. The reports are written in a way that if nothing goes wrong and everything goes perfectly, this is what's going to happen. And in mining, something always goes wrong. So you actually have to have some safety factors built into your studies.
So with these technical reports, in your mind, when would be the best time to start putting economics within the report? It doesn't sound like a PEA is where, in your mind,
Well,
is where it should lead.
when I'm involved in a company, we're doing these things internally all the time. We're always like looking at it. We're looking at the shapes of the ore bodies. Do you want to build an open pit here? Do you want it to be an underground mine? What's it going to look like? Do I have a payback pit or a payback area where I can mine it and get my capital back quickly? Those are the things that you're constantly stress testing. And when you actually find that, even though you're doing it internally, you go and poke a bunch of more drill holes into that area, so that you can actually be confident that that part of your ore body is real. Because if we're going to build a mine, we really want to get comfortable that we're going to get our capital back as quickly. So that part of your thing, you're actually de-risking the ore body by really making sure that part is as solid as it can be. And so from my perspective, these things are ongoing. But when do you actually? I think you publish a report when you get to a point where I think you want to be able to demonstrate the types of economics that this deposit could have. But I think you have to actually be more realistic and stop using these documents as a marketing document, because they're not. Let the engineers do what they do. A conservative report can serve you way better than an optimistic report. And the people that know what they're doing actually know the difference. Like, you can say, oh my gosh, they're saying that they're going to mine an open pit for this cost per ton, when the guys 2 miles from them have another open pit and their costs are 20% higher on a per ton basis. Like, it's not hard to figure out that they're going to probably have the same cost structure.
Do you know Nick Michael, formerly with Orion Finance Partners?
I don't.
Okay. I thought he's a School of Mines grad as well, but I did a presentation with him a couple of years ago. It was probably about 4 or 5 years ago, and he got up on stage at the AEMA talk, and he was saying, and this because he was coming from Orion Mine Finance, obviously they look at later stage projects, but he was firm in his belief that he doesn't think any PEA should involve any economics, that it should be as simple like, here's what we know. If a mine were to happen, here is potentially what a mine operation would look like. And even economics, because there's just not enough drilling, right? There's not enough definition happening in PEA, even for its maiden resource estimate. Like, the extent of projects just haven't been known. And so he also has had the luxury of, they're not going to enter any project until later down the life after a feasibility study. So at least he has that. But, it's just interesting to understand, when you put economics in. And also, I a lot of times I come to question when companies say, oh, we've got a PEA we're looking to publish here, next quarter or the end of this year. And I keep thinking, it's like, you've only done like 15,000 meters of drilling. And my question is if that's even enough for a PEA.
Probably not. I mean, I think that some people come out with a PEA too early. Some people bypass the PEA entirely. I mean, but I think when you actually have a visual deposit that you can see through enough drilling, where you can visualize it, I think whether you publish a PA or not, or you just do one internally, you're going to do it internally just because you're going to say, what am I trying to design here? Like, one, you don't want to waste people's money. So if you're going to go drilling, I mean, I've seen projects where they just keep drilling and drilling and drilling and they never stop. And you kind of ask yourself, like, what are the returns of capital on this drilling? And there are none, because they don't really have a target. At least a PEA gives you a target. What are you shooting for? Am I shooting? Does this look like it's going to be a mine that's underground, that's going to be 1,000 tons a day? If it is, you can figure out through a PEA what the cost structure should be. What type of grade am I going to need to make a decent return here? So a PEA can answer a lot of questions if done properly. The problem is they've turned them into marketing documents rather than useful tools in the design and construction of a mine.
Yeah. You did mention you're able to really tell the difference in these technical reports about, what's a good technical report and what's not a good technical report.
But
You've got
not
a good,
always.
okay, fair
Not
enough.
always. I mean, it's
I've,
one of the things we used to say is if you kind of take in some of these technical, I mean, some of my problems with technical reports is, I don't remember the exact thing, but like a PEA, I think that the numbers are supposed to be plus or minus 35%, and in a pre-feasibility is supposed to be, I think, 15%, and I think 5% for feasibility. So I don't remember the exact numbers, but when they say plus or minus, have you ever seen a PEA that had a higher capital cost than the pre-feasibility or the feasibility that came after it?
oh,
Because I,
certainly not. Yeah, certainly not in the last couple of years. No, I mean,
but
if ever.
there should be. The reality of these, that's part of the problem is that they always understate capital in the PEA phase, and that's so you want to be realistic. You want to actually, basically, you want to overstate capital, because when you come up with the next one and you're going to show a lower capital number, people are going to say, why? And you say, well, we're just a little too conservative there, but now we've nailed the numbers down. If the PEA still says you got a good return and you've overstated things, it's only going to be better. So, as I said, I think, ultimately, the most important thing is that we don't waste money and that we use the capital in a wise way towards the construction of a mine that makes sense. Even if you sell the business, you still want to design a mine that makes sense. And to me, the PEAs start by taking on the wrong track.
Yeah. Since 2020, especially in the height of inflation, when those technical reports were published, it didn't take long for investors to really, in the back of their mind, say, all right, here's your CapEx. Now add 20%. Because that's what we saw. We saw so many projects, in construction phases that have to go back to the market to finance their CapEx overruns. Is that behind us, or do you think that's just getting started?
I don't, unfortunately, I don't think it's behind us. Some of it's honest. I mean, as you go and take that project and do a better job scoping it and do more details. And I'll give you an example. When we put in an underground crusher at our mine in Bulgaria years ago, when we did our initial work, we thought we were going to need to have, I think it was 5 or 6 conveyors. As we did our geotechnical work and really saw what the ground conditions are, we were going to need more. So we actually had to do more underground excavation and more conveyors, and more conveyors meant more capital. And so some of it comes by, honestly, as you get more engineering data, and you get the ability to make better decisions, you find out that some of the things that you had estimated before, which could be honestly estimated, are different. But then there's other times where it's just the estimates are just too aggressive. So I don't. And then there's a third part, is that there's going to be inflation, especially what we've seen is when the industry takes off and everyone starts investing in this industry at the same time. Well, everybody's going to be looking for drillers. Everybody's going to be trying to buy ball mills and sag mills and conveyor belts all at the same time. And inevitably, you're going to have cost inflation, because the handful of people that produce these are going to have huge lineups of people that want to buy them, and they're going to have to run their shifts at extra overtime, and it's going to cost more to make. So inflation's not done, and it never will be on the mining side, especially when you're trying to build a lot of mines. And you can work some of that into your study numbers with just conservatism.
Yeah. So I would like to ask you, and maybe get some advice from you. Like, you're fortunate enough, you have a great team, technical team behind you that can sign these confidential agreements and start doing these due diligence. But for the, for the lay people such as myself here, John, that do not have that, what are some things you would be looking for in these technical reports to make our own decision? Is this good? Is this a good report, or is this a maybe concerning report?
I think one of the things is we always look at is the ultimate grade as a percentage of the cutoff grade. Because in theory, your cutoff grade is supposed to run to your cash costs. So if your cutoff grade is 1 gram a ton and your ultimate grade is 1.75 grams a ton, what that report's really saying is your margin is 0.75 of a gram. And we like to see projects where there's at least a 50% margin. So on a very quick eyeball, you can look and say, well, if my cutoff grade is 0.5 gram and my grade is 1.5 grams, there's a lot of margin for error there. Even if I'm a little wrong in my cost estimates, we're still going to be good. So those are some of there's a lot of quick stuff. We try and look at tons per vertical for underground mines, tons per vertical foot. And so you look at how deep the mine is and how many tons you get per vertical foot. And there's an old rule of thumb that says your ultimate mining rate should be 40 or 50%, between 40 and 50% of your tons per vertical foot. And you can do it on tons per, I just don't know the conversion on tons per vertical meter because I've always done it on a per foot basis. But early on in my career, when I had this little ratio, I was looking at a project, and it was in Quebec. And I spent the day, and back then we didn't have computers to do this, where we did it. We looked through cross sections. I went through every cross section to check the resources, and everything looked pretty good. And so finally I said to the guy, when you look at it, your ore body runs from, like 100 meters to 1,000 meters, and on a tons per vertical foot basis, that you would, looking at the deposit, this should be a 400 or 500 ton per day deposit, but yet you built a 1,500 ton per day mill. How are you going to get the ore at that many ore to the mill? And it was one of my favorite defining moments, because rather than make eye contact, the geologist was looking down at the ground, and he said that decision was made in Toronto. And that was his answer. And I knew right away, like, this due diligence trip is over. So some of these rules of thumbs can serve you well, and those two have served us very well. And those are very quick kind of eyeball things, but they can actually lead to asking some good questions. And you can see how awkward the guys get on the other side trying to answer them.
Do you have, I don't know if faith is the right word, but take into consideration maybe new technologies being used and utilized in those, like PEAs or PFSs, ore sorting, or if you look at maybe some new metallurgical type recoveries from sulfide, like, for example, Rio Tinto's Newton technologies and the like. I mean, is that something that you can firmly say is going to add to the economics of projects, or is that something that's kind of a wait and show me?
Well, I hope it's going to add. I mean, we are big believers that one of the things the mining industry has to do better is embrace new technology. So it would be, but I don't think it's not. I don't have faith in new technology. We actually try and, when we see we try and look at it. We try and understand it. We try and understand the chemistry or whatever the technology is. I know when we were in Bulgaria, we implemented a lot of really interesting new technologies. We were one of the first mines in the world to have internet in an underground mine, and that saved us huge amounts of money, because you could now operate your mine in real time. Whereas before that, and people never really thought about it, is that when you would go down for your shift, you didn't really find out what's going on underground until you actually got to the working phase. Whereas when you're operating in real time, you actually can know what's going on before you even walk into the mine. So um, as an industry, we need to embrace new technology, but you have to be careful. No one wants to be the first, as everyone wants to be the second. No one wants to be the first. But for a new technology to be probably, we actually have a technology business at Dundee where we've got two metallurgical technologies, and they're great technologies, but it's a very slow sales cycle because our industry is very slow.
Was that the technology? Was that at Chelopech?
Well, we didn't use it at Chelopech. One of them we actually did use in our smelter at Sumac, which was it's called glass lock. I actually have a sample right here, and it actually is a method of taking arsenic out of the ore or the concentrate and storing it in the matrix of a piece of glass, which is very environmentally friendly. You could take the glass, you could shatter it, the arsenic will never get released. And it's actually a better environmental solution than an autoclave. And humorously, the process to get it is actually cheaper than autoclaving. So we're working hard to market that technology. And the other technology we have is a technology that will replace cyanide on recovering gold. And, there's a lot of places in the world where cyanide is sensitive, and we're working with numerous companies and trying to get that technology over the line as well.
I remember when I was first getting started in this industry and really just green as anything, and I just knew very little. My friend and mentor gave me this white paper well, he was working at the School of Mines at the time. He gave me the white paper, Taking the Lid Off, which was about the technology advancing.
That was
Yeah.
Chelopech.
Yeah, Chelopech. And so that was one of the first things I ever read that kind of started me down this pathway in mining. So things come full circle.
I've been trying to quantify the value of that. It was unbelievable.
Yeah.
That's made itself back in days.
Well, and maybe, it was like a first movers thing, right? I mean, a lot of people continued to be kind of old school in their ways and didn't trust the technology. And I think you went out there, you were chairman at the time, I believe, and you took on the risk and adopted it, and all of a sudden you could maybe make the argument that it changed the industry of mining operations forever.
Well, I mean, I'm fortunate that my job in this whole taking the lid off was just to say yes. But the real credit should go to Rick Howes, who was my COO and became the CEO when I moved to executive chairman. And Rick had spent much of his career in the Sudbury Basin, and Rick's a spectacular mining engineer, but he was always very frustrated by what I just said before, the fact that mines don't operate in real time. Open pit mines operate in real time. When you go to a big open pit mine, there's that control room. It's almost like a control tower at an airport, and you can see everything that's going on in the mine. Where in an underground mine, you don't have that. And Rick's vision was to actually have a control room that you could virtually see everything going on in the mine at the same time. And that's that. And as I said, my guilt is I said yes when he needed some budget to start making that happen. I'm the first one that said yes. But he did a great job, and it was a wonderful exercise. And Chelopech is a very, very modern mine in a part of the world you wouldn't expect to see a very, very modern mine. And it also changed the culture, because the culture now is if someone sees a new technology that looks interesting, they're going to grab onto it quickly and say, let's go try it. Let's see if we can make it work in this stope. How's it going to play out? Is it right for us? Is it wrong? So it was a tremendous experience, and more companies need to start doing that and even taking it to the next step. We've all got engineering degrees. We need to be more creative.
Yeah. Let's turn our attention back to Dundee Partners here, and I want to ask you kind of about the bread and butter of the company, and when you enter positions. Looking at the portfolio, there's a lot of earlier stage type of exploration development projects. Is that really the area you really focus on? And you've had the nice win with Reunion, obviously, still have significant ownership in that company. But what is the bread and butter with Dundee Partners?
The bread and butter is really, I call them exploration/development, because very rarely will you see us enter something that doesn't have either a resource or enough drilling where if you looked at the data, you could put together a resource. So we don't invest in a lot of grassroots exploration, but and I think that's what our team does well. I think one of the things that we went through in Bulgaria is we had to figure out other ways of doing the mine. We couldn't, like, for example, we couldn't use cyanide. So we actually floated a con on both of our mines, which forced a certain bit of flexibility in realizing there's more than one way to develop a project. And so, a lot of my team is the same team that I brought over from DPM. So we spend a lot of time looking at these things and saying, does management have it right here? Is there a better way to do this? Is that open pit really an underground mine, or would they be better to do it differently metallurgically? Or so, and I think that's where we're really good. You can make small changements in some estimates, and you can get very significant changes in what your resource is, what your payback pit is. We really like to see projects that have a quick payback, because we barely know what the price of gold is going to be tomorrow. The farther away you get, the less certain you are of the metal price. So why not make sure that that payback happens quickly? You've got a better chance of success. So that's really where we can add a lot of value, and that's why we tend to gravitate towards those types of projects.
You take large positions. In fact, out of the portfolio, just looking at the website in your assets, you have one that's 8%. Everything else is double digits, up to 20% ownership of these companies. And I just curious, why take such large positions? What is kind of the base case for Dundee to have those large positions? And then also, are you currently looking to take on new positions? When was the last one? Just kind of general thoughts on
Well,
when that's going to happen.
right now, we're not actively looking at taking on a lot of new positions, because a lot of our money is tied up in Reunion, which is a very, very large position. It's, the value of Reunion is more than our entire market cap. So you could argue you're getting everything else in Dundee for free, but that's kind of so we spend a lot of time looking at our existing positions. And the reason we take large positions is, we need to be part of the game. Like if you own 19% of a company and you have a disagreement with the CEO, you're going to get a hearing. If you own 3% of a company and you have a disagreement with the CEO, they're going to go tell you to go away. And as I said, we want to know that, and we're perfectly very comfortable to have disagreements. I mean, I know it's we do enough work on these ore bodies where we know the shape of the ore bodies. I would argue in many cases we know these ore bodies better than the company that runs the team that runs the company. And so we have a big enough position, whereas if we have to take them on, we can.
Mm-hmm. Are you unbashful to be that activist shareholder if need be?
I have, as I said, I said, if I'm going to be wrong, I'd rather it was me that was wrong than I believed someone that lied to me. So yes, we do a lot of our own work, and I have no issues, being activist. Most times it doesn't come to that. Most times it's you sit down and say, hey, we have a disagreement here. You get your technical guys together. We'll sit down with our guys. Let's put all our cards on the table and figure out if we've made a mistake or if you've made a mistake. And what's interesting is, and where you can get frustrated at times, is a lot of times you get the CEO comes back to you and says, okay, well, you're probably right here, but that means I have to go to my shareholders and tell them this. And that's where I say, so go tell them. Just tell them as you've analyzed the data, your conclusions have changed. They'll understand. especially if there's still a great opportunity. So that's where it can get frustrating at times, because a lot of people don't want to ever admit to having made a mistake. We all make mistakes, and it's not even mistakes. As you get more data, conclusions change.
Mm-hmm.
But I think it's very important. And one of some of the companies we work with, I love the CEOs that are, their attitude is, I just want to get it right. If you've got an outlook that's better than mine, I want to hear it. Those are the ones that I like working with the most, because that's our attitude. There's many times we've sat down and said, okay, what you're saying makes sense. We'll back off. We didn't think of it that way, or there's extenuating circumstances. But at least you had the dialogue.
Yeah. How do you, I mean, is there an art or, a great way to manage those relationships between you and Dundee partners as major shareholders of companies and CEOs and the rest of management teams? I think I mean, how do you separate, the relationship from business, or is it always just strictly 100% business?
It's never always 100% business, but I think you actually have to have a very recognize that, we are, at the end of the day, we all own shares in a company that if you're the CEO, you're running it, and we're going to have disagreements. But let's put all our cards on the table and say, look, our disagreements aren't coming because we think you're an idiot or a bad person. We think you actually believe what you're saying, and we believe what we're saying. And if we can actually have a mechanism whereby we're all comfortable to talk about it, and we're all comfortable to recognize that if some of our assumptions are wrong, we need to look at it differently, then you only get to a better place by having those conversations.
Mm-hmm.
And the reason, and that's why we like the bulkier positions, because we don't take those positions until we've done enough work to make sure there's an ore body there, where you actually see some type of an economic mineral deposit. So that to that end, we feel like that it's lower risk. We know it's not lower risk from a liquidity point of view because you can't sell it. But early on, I'm not going to name the company. We were involved in a company, and we didn't agree with their strategy. And basically, they told us, we tried to have the meeting and explained and showed them some of our models, and they were, and at the end of the day, they just said, well, we don't agree with you and you don't agree with us. We're just going to do it our way. And we didn't have enough of a position in that company to push. So we ended up selling our stocks and taking a loss. The humorous part is they're now doing it our way, because they realized the stuff they were chasing didn't connect. But we didn't like that. We did, we know that if we had owned the type of position we own now, the conversation would have been different, and we may have got to a better place.
Have you ever been in that position where you had enough ownership in a company and things were not going your way, or, you were maybe butting heads on strategy or process, and things just could not be solved, and you had to go full activist and push for a change in management?
It's I'll give you an example of one we went through recently, and it wasn't a full change in management because the old management is still there, and we came to terms with them. But the example was a company in Australia, and it's called Osgo. They have a beautiful deposit. It's about a 2.5-hour drive from Perth, and they the part that we didn't like is they changed their feasibility study mid-feasibility study, and it didn't feel right to us. Our project people said that's a no. You don't do that. When you get to the feasibility stage, you commit to it. Whatever you're going to do, you go and you do and you make it work. And they were running out of money, and they hadn't acquired the land they needed. And we were shareholders, but we'd been shareholders for a long time, and we said, okay, what are we going to do here? And truthfully, we weren't sure that we weren't just going to take our lumps and sell. And we sat down and worked with a few other groups. We put some funding into the company as in the form of a loan. We signed a brand new CA, and we did a whole bunch of work, and we really stress tested the ore body. And by stress testing is we diluted it dramatically and took the grade down by about 13%. And then we ran some financial models off that, and we found that it still has a really good, it's still a very economic deposit. And that made us very comfortable. And from that work, we were able to work with the groups that we were working with, and they helped them. We put some money in, and they got outside investors, and that company went down and raised $38 million. We also put in a brand new executive chairman of the company, a guy named John Dorward, who used to do Roxgold, and he's now executive chairman of Osgold. And the CEO of the company, who's a very talented geologist. In a lot of senses, it's now value added because he's now free to do a lot more geology, and they've got a huge land position. So within the financing, we raised enough money to give the CEO a proper budget to go and attack and to focus on his core strengths. Brought in an executive chairman who can actually work with the engineers and get the study and the feasibility back on track and the permitting back on track, and obviously enough money to buy the land. In my view, it's a much better company as a result. And we think, we raised the money at 3 cents a share, and the stock's trading at about 3.6 cents a share, 2 weeks later. So that's been, you don't have to necessarily fire management to change it, but we were able to recognize that management wasn't bad. They were really talented, but they weren't being used to their core strengths. So by working with them, and they signed off on all these changes. This isn't us forcing them to. This is and I think everyone, including them, agrees this is a much better company now. And I'm personally of the belief that freeing up the CEO to do more exploration is going to find a lot more gold. So
with exploration companies, I've, at least in my own portfolio, John, I've been diving more into private companies lately, I would say last year. And I guess I wanted to formulate the next kind of topic about, when it is appropriate for exploration companies to go public. I love giving credit. I love the venture exchange in Canada because I'd never seen a market take an idea and just monetize it so well. And it's not just mining, it's anything the venture picks up, it's just remarkable. I think that's why I love it. I love those stories, but I also have seen the downside, right? Evaluations are a little too high for hopes and dreams. Yeah, exactly. So there is this kind of ongoing debate, at least in the back of my mind. Okay, like, is an exploration company, if you have no economics, you have a project, you got to do the drilling and kind of prove something out, is it more beneficial to stay private than it is to go public? Do a lot of companies go public too soon? And just this debate between PriveCo and PubCo, and obviously there's the public markets should provide benefit, right? You should be able to capitalize that, but do a lot of companies do it way too soon?
I think there's a lot of public companies that never should be public companies, and as a result, they really aren't public companies. They're private companies with a share listing and a share symbol because they don't trade. It's like,
right.
Go to sell it, you can't sell it anyway, so it might as well be private, because being a public company has a cost to it. But I think you have to be able to go public. You actually have to be able to tell a story of what you're going to do and how you're going to do it to enhance the value of the share. And if it's just that we're going to drill in a bunch of spots and hopefully we'll get lucky, chances are you probably shouldn't be doing this yet. But you're right. A lot of people's goals are to run a public company. It's way easier to be in a private company. So Yeah, I would agree with you. It happens too soon, but when you actually have a story to tell and you need capital, the public markets can be very useful.
I mean, if you had it your way, if you wrote the laws of of public markets, John, like when would be that last approval be? Would it be a discovery hole? Would it be some sort of maiden resource so you could put some sort of valuation on it? Like when would it cross the line?
Well, it would. I mean, everything would be different, but it would be, you know, you go public because you need to raise more capital than you can as a private company. If you could, every time you needed money, pass a hat around a handful of people and they're all going to participate and give you the money you need to advance your projects, you never come public. But inevitably, every project, whether it's if you have a big porphyry system, you have to come public a lot earlier because it's going to require a lot of drilling. If you, yeah, so it really depends on what you're doing and when you're trying to do it. But you know, once you're in the public markets, you need to have a story to tell, a raison d'etre. So to me, and the story has to be more like we're throwing darts at a dartboard and hoping to get lucky.
Right. Well, in promotion, marketing promotion has a lot to do with that. And in fact, in that white paper you wrote a number of years ago, The Elephant in the Room, you mentioned a little bit of marketing promotion. I mean, what are your thoughts on that fine line between promotion, marketing, and overly promotion and I guess pump?
Well, there's nothing. Promotion is part of the game. We have you have to promote. You have to, but you know if you can promote truthfully, like if I told you that I had this beautiful geophysics anomaly and it's in an area that has very big and rich deposits, and sorry, I've got 10 of these anomalies and I want to raise money to go drill all 10. And if you look in this area, you see some of the largest mines in the world. They're risky, but a lot of people would say, you know what, I'm not going to put all my money in it, but I may put 3 or 4% or whatever. I may take a shot at this. That's perfectly good. And you promote it and say, look, we got a 5 or 10% chance of having something very, very special here. That's great. But it's, some of the promotion becomes, people use words like sure thing and stuff words you should never use. And that's where it gets a little dicey is when you're not necessarily telling the truth. But I think, I once looked at it because we were involved in a project that had an opposition. And I said, here's the thing, this is a very, very valuable project if we can free it up. But if you can't free it up, it's going to be worthless. And here's the plan. And would you invest? And most people would say I would if you laid it out that way completely honestly. And the reason I actually suggested that at the time was because I was very frustrated at the time because very rarely there's very few projects that don't have some opposition to it. There's someone out there, and if they have the internet, they have the ability to be disruptive that doesn't want that mine built where you're going to build it. So when you have all these CEOs saying everybody wants it, it's really popular, you know that they're not telling the truth. There's always someone that's against it. But most mines can get over the top by working with the communities and working with the people. And most investors, if they understand that there is some opposition, and you talk to them honestly, but talk to them as a trade-off and risk and reward, they'll still invest, provided you have a plan on how to handle that risk.
Do you take dives into, I guess, the alignment of management with shareholders? And, you could say, management owns, 30% of the company, but they took their seed shares, got a few million shares at, tenth of a penny of some sort. Does that matter to you?
Need seed shares. I really do believe management needs to have some real skin in the game, and not skin that was given to them for free. They need to have real skin in the game. And so when we don't always see it when there's seed shares. Some of these things you see long after, but when we're involved in something where you can see that there's seed shares that were just given out 6 months ago, and the new stock being issued is like 10x, and they really haven't done anything except acquired the property, or closed the deal that was already on the table, it does get very frustrating. And usually we start with a very, very strong negative bias not to invest when those exist. But I think, I always want to see somewhere where they've written a real check to buy some shares.
Yeah, absolutely.
And
All right.
you have something to lose.
All right. John, I've taken up a lot of your time. I really appreciate what you gave to us. This is a great conversation. I could probably take another hour, but I know neither of us have it. So,
Happy to
but
do it again sometime. And
yeah, you know what I'm going to do? And we'll wrap it up this way. I'm going to put a link to that Elephant in the Room article because it's still pertinent. And a lot of this conversation harks back to what you wrote. And I think even, what is it, like 5 years ago you wrote that, 6 years ago? I mean, it's still, you could have written it yesterday and it'd still be verbatim the same in a lot of these aspects. And so I'm going to put a link of that in the show notes for people to do. But I just quick question. I'm like, in general, any of those things that you wrote about then, have any of them been improved on? Are there signs of life here in the sector based on what the challenges were you wrote about?
the part where I do see improvement is more on the middle cap companies. I think companies are spending a lot more time focused on how to spend their capital wisely and understanding that capital allocation is a big part of the game. And the mining companies are not as reckless with their capital as they used to be. But other than that, a lot of the other stuff that goes on, you're still seeing reserves and resources misstated, or because they use the wrong block size, then they want to get 3 million tons a year, but out of the mine, but they're running small open pit blocks, which you're never going to be able to mine that tonnage with that block size. And so inevitably, when they go to mine the mine, there's more dilution and the grades come in a lot lower. You still see a lot of that, and I think that we need to become more predictable, because if we're ever going to invite the generalist investor back into our industry, the generalist investor doesn't want to be right on the metal and wrong on the stocks. They need to be able to trust what companies are telling them.
Well put. All right.
Okay.
Jonathan, thanks so much.
Thank you.
Have yourself a great rest of your day and a great weekend.
Take care.